So what are the permanent differences, what are the timing differences, and how does the reconciliation look like? So this is just an example taken from a listed company outside India, how globally the reconciliation is shown. So this is the tax rate of the government. Your tax rate is which is different, lower than this. What are the reconciliation items? So till now, this used to remain only with the management and the auditor, probably as a working paper. Now this working paper is actually a public document, So if there are any errors, till now it was, investors probably never knew. But now all this would be visible and available with the investor. If there are any errors, this will be clearly visible to the investor. Classification non-current in IND-AS, we have seen that income tax disclosure almost same disclosure. Okay, as compared to till now, whatever differences we saw were actually Indian GAAP and IND-AS. Now, the difference between IND-AS and IFRS is only one. That in case of investment property, the accounting treatment is different because in investment property, under exception, we have not taken that exception of valuing investment property at a fair value. So to that extent, there is a difference between IFRS and IND-AS. That is it. I had some 2-3 points which I wanted to actually speak to you. Indexation benefit. The question is, the land, freehold land, enjoys indexation benefit under income tax. So should we recognize deferred tax asset on indexation benefit, right? So the answer is yes. Ideally, should recognize unless the company has a different plan. So every year, when the indexation benefit accrues to you, every year we will recognize the deferred tax asset to that extent. I think more or less actually I have covered, but I think as I said in the beginning, whatever we discussed so far was all on account of deferred tax. But the one particular and very typical item and which could have major impact is on current tax on account of MAT liability. And there is already a report issued by lawyer committee, which is still not getting implemented. I don't know what status it is, but it says it gives basically 3 options. So for example, investment which are in FVPL, so fair value through profit and loss category. You have investment which you don't want to kind of sell in very short term, but still you have categorized those as FVPL. Now when you book this gain through fair value through profit and loss, as far as normal tax is concerned, you will not treat this as a tax liability, because finally eventually it is not sold off. It is just a book value, book entry. But for MAT, this will be regarded as a tax liability. Now, once you regard this as a tax liability, it can have a severe impact and significant impact on the tax liability. Maybe eventually you will get MAT credit entitlement, but from particularly from cash flow point of view, it can have a severe impact to many corporates. So what I understand is the committee has recommended 3 options. First is don't recognize or don't have any tax liability on this at all. The second is have full tax liability in the first year itself, and the third is amortize this liability over a period of 3 years. What is pertaining to opening? So, for example, balances which are continuing since a long time. You would have invested, say Reliance at 100 rupees 15-20 years back. Same Reliance is now 1,200 after bonuses and after splits, right? So the value probably of 1,000 could be 20-25,000. Now, if you take the 24,000 immediately in the first year as taxable, it could have severe impact. So let's see finally how the lawyer committee recommendations are implemented. Yeah, so that's it from my side on income tax. If there is any question, you can take. Sure.
So we have 10 minutes to break, 10 minutes to record. I can see among the previous guys. So let's assemble in 10-12 minutes.